Good morning, everyone, and thank you so much for joining us here today. My name is Christopher Clark, and I'm the Senior Manager of Investment Management here at Scotia Investments Trinidad and Tobago. Welcome to the 15th episode of Scotia Insights, and today you're attending the second chapter on investments with the web version of the series. Launched in February 2016, Scotia Insights is meant to bring a deep sense of understanding and awareness to our customers. Featured guest speakers share their subject matter expertise, and the audience is then encouraged to ask questions and engage in an insightful discussion. As you, our investment, premium, and VIP customers join to learn more about staying invested in a post-pandemic world, we hope that our presentation today will inspire you to consider and make necessary changes to the way you think about your current and potential future investments. It's my pleasure to join you today for today's thought-provoking discussion. Before we get started, I just want to briefly touch on a couple of house rules. Don't worry, there are only 3. You're encouraged to type any questions you may have on today's topic into the meeting chat. That's as the presentations are ongoing. Once the presentation portion is complete, we can then move into the discussion. And when your question is selected, we'll actually unmute your mic so you can speak and you can ask the question to the panelists yourselves directly. Now, allow me to introduce our esteemed panelists for today. Joining us from Toronto, we have Judith Chan, CFA. She's the Director of Portfolio Solutions at Scotiabank. Judith will explore expectations for the post-pandemic global economy, and she'll also provide some recommendations and investment strategies for today's uncertain market environment. Judith serves as a portfolio manager for Scotia Strategic ETF portfolios, where she oversees approximately $35 billion Canadian, in assets under management, and is responsible for portfolio construction, asset allocation policy, and ETF strategy research and selection. The team is also involved in the due diligence and day-to-day management of all Scotiabank portfolio solutions. With more than 15 years in the investment industry, Judith has held progressively senior roles in investment management, research, and oversight. Welcome, Judith.
Hi, everyone.
Thanks for joining us this morning, Judith. Great to have you here. Really looking forward to your presentation. Also on today's panel, we have Crystal Salazar, CFA. She's a portfolio manager here at Scotia Investments TT. Crystal will share insights on recent developments in the domestic economy and local markets, and she'll also share her short-term outlook and some TTD investment strategy recommendations. Crystal joined Scotia Investments as a manager asset management in July 2016, where she's jointly responsible for the oversight of approximately 3.5 billion TTD in assets. Her role involves investment research, asset valuation, and the development and execution of investment strategies for institutional clients. Crystal is a respected practitioner in the local industry with over 10 years experience in investment management at leading domestic financial institutions across the mutual fund, insurance, and pension plan spaces. Welcome, Crystal.
Hi, everyone.
Thanks for joining us this morning, Crystal. Looking forward to your 2 cents as well. Thank you, everyone, for joining us. And without further ado, I'll now hand you over to Judith to kick things off from the international perspective. Judith?
Hi, everyone. Again, thank you for having me on this call. It's my pleasure to be here, so thank you very much. Without further ado, I will just go on to my presentation. I think I'll start with an economic update, and then we'll go on to Outlook. So next slide, please. Yeah, next slide, please. Yeah, so as you can see here, this is showing the global manufacturing in the PMI number. What you're seeing here is that it is a comparison between what we saw last year versus this year. As you can see on the right-hand side, we're firing on all cylinders amongst the developed nations as people get vaccinated, and the pace of vaccination is actually speeding up. Economies are also opening, so you see the manufacturing activities actually in the rapidly expansion mode. The exceptions are China. China is business as usual, not especially in a recovery mode because activities didn't actually quite stop. And Mexico is slightly lagging, but it's also showing a positive sign of direction. So you can see that, as the economies reopen and they continue to drive growth as people are getting vaccinated. Next slide, please. As you can see here, the global economies are, you're seeing a corresponding rebound in economic growth. So this year we projected to have a positive level of growth in 2021, but there's a lot of nuances in the recovery. The pandemic has restricted a lot of consumers' options for consumption on services like airfares, hotels, travel, restaurants. Consumers shifted their consumption towards durable goods. So we saw demand for furniture, electronics, cars, and other manufactured goods rising. Companies in various industries were impacted very differently across different segments within the economies, and that explains a lot about what happened in the market. Next slide, please. The labor market is also very interesting. We obviously saw unemployment rates spiked during the initial stages of the pandemic and the lockdown. So it has gradually been improving, but we expect this number to stay relatively higher than the 4% level that you saw just before the lockdown, just before the pandemic. And we expect some level of permanent scarring. So it will take a while to get back to a pre-pandemic level going forward. And this is a key metric that we are going to watch for, as it's one of the two mandates for central bankers. The central bank's mandate is to keep a high level of employment as well as keep interest rates, keep price levels stable. And with the unemployment rate higher, this would indicate their willingness and their ability to maintain a high level of liquidity and maintain a low level of interest rates going forward. So if unemployment stays higher, they will be more willing and more likely to keep interest rates low and keep pumping liquidity into the financial system. So this is a key metric that we'll continue to watch. Next slide, please. So year 2020 was obviously the year of stimulus packages. We will see more in 2021, as we have already seen. So the governments are using both fiscal and monetary policies to stimulate the economy and to extend the safety net to mitigate the economic disruptions. But with rates near 0%, fiscal stimulus needs to play a bigger role along with the monetary stimulus to stimulate the economies. But we already saw the 1.9 trillion fiscal rescue package from the US, and US is also working on the next round of stimulus, which is closer to over 2 trillion, almost 3 trillion in stimulus, which includes funding of bridges, broadband, and other traditional infrastructure projects. They also have other kind of social infrastructure projects, such as maintaining the child tax credit or access to healthcare, or possibly something on student loans as well. And with this much money being pumped into the system to support the economy, as you can see, the explosive growth in central banks' balance sheets. What the market is worried about is the impact to the market and the impact to inflation down the road. And it's not a straightforward answer. There's a lot of nuances to the level of inflation, as well as how the volatility of inflation. Next slide. So, as we can see, bonds, next slide, please. Bond yields have already rallied since November to quite significantly, quite dramatically, as you can see here. I think we've skipped a slide, so last slide, please. So, the upward pressure on inflation was actually multiple number of factors. We have also, between the inflationary pressure as well as the inflationary pressure, it's coming from a lot of the value chain disruption because of the pandemic. The economy it's not like a switch where you can turn it on and turn it off randomly. There's a lot of value chain that got disrupted. In terms of wages, there's also a rising demand for a higher minimum wage, so that puts pressure on inflation. We also saw energy prices rallying, with the rallying of energy costs being one of the highest input costs. That is a big pressure on the inflation. Also, with direct paychecks coming from the government, with that increased money supply in the personal balance sheet, it's very likely that we're going to see bouts of inflation higher than what we've seen in the last many years. But there's also a lot of downward pressure on inflation. We're seeing slower labor force growth, with slower growth and some permanent scarring because of the pandemic. That is a deflationary pressure. We also need a sustained level of productivity growth to maintain a higher level of inflation. And that's highly questionable whether that higher productivity because of technology advances can translate into a sustained earnings growth in companies' earnings. That's questionable, and we need to see a sustained level of growth for a sustained level of inflation. And also the last thing is whether the monetary and fiscal stimulus will continue to be high. Inflation will continue to be volatile because of this upward pressure and downward pressure on inflation. But there's also, because of the pandemic, there's also a lot of transient spikes in prices because of this disruption. We see it in grocery stores. Grocery prices have gone up. We see used cars prices go up. And also there's also the reopening of the economy. So with the recovery in reopening in restaurants, in hotels, and air travel, we may see spikes in prices, and that is all registered as part of inflation. So we expect inflation to be high this year, but depends on the level of spike. The market typically can digest a moderate level of inflation, and that is relatively transient in nature, and that probably will be reflected in a higher level of bond yield. So with the bond yield, the recent dramatic bond yield in the developed markets earlier this year, we expect the central banks to the trillion-dollar question is whether the central banks will have the willingness and ability to step in and to control the yield curve, basically, to have if the long end of the yield curve steepen any further, we may see the central bank step in to do yield curve control. But as a result, you can see that on the year-to-date basis, the fixed income market have given back some of the outsized gains from last year. So let's switch to the market a little bit. So next slide, please. Skip over the heading slide to the next slide. One more. One more slides ahead. Yeah, one more. This one. Okay, so the most noticeable movement this year is the rally. Oh, sorry, one slide back. So the most noticeable rally was the rally in the oil prices this year. The countries that has more cyclical industries has been leading the rebound. And as you can see on the left-hand side of the slide, fixed income market has given back some of last year's gain. And this is as of February, and in March, the market has given back even more. So on a year-to-date basis, including March, the fixed income market has given back about 4% of last year's gain. But corporates as well as high yield credits has done better and has been able to remain in the positive territories. Emerging markets led, as you can see here, I said that the red bar, emerging markets have been leading to the end of February, but I think they took a tumble in March, and that's mainly due to China, as the government started to tighten liquidity to avoid an overheating of the economy. So we're still seeing a moderate level of gain, but there's a lot of nuances, a lot of changes within the market. Next slide, please. So it's a tale of two periods. What I'm seeing here, what I'm showing here is the top half of the chart versus the next half of the chart. The top half is showing March 1st to October, which is just after the end of just after the beginning of the lockdown to the end of October. And since November, ever since the bond yield starts picking up, we've seen a rotation in many aspects. What we're seeing here is what we call the short duration equities rebounding quickly, and where the longer duration equities are giving back a lot of their gains. So what we mean by the short duration equities are the bricks and mortar industries where their valuations are mostly based on near-term profitability and cash flow, which are starting to rebound. But also included in these segments were the companies that are severely affected by the lockdown and are now starting to reopen. So as a result, we've seen a pretty significant rebound of these companies. And the longer duration industries would include the ones that are where their valuation is based on cash flow and profitability that's far into the future. And the current valuation is a discount of their future value back to the present value. And we've seen them doing really well right after the lockdown in like technology industries, in the stay-at-home segments. So they benefit from the pandemic because they've captured market share and growth for the next couple of years. So they've done really well, and so in the recent months, they've been the source of capital, and they've given back a number of gains, quite a bit of their gains from last year. Next slide, please. So from a factor perspective, we look at it from a different perspective, looking at the nature of the valuations and the nature and their volatility and sensitivity to the market. And as you can see here, value has rebounded versus growth. So the left-hand side, the two section on the left shows that value did poorly last year, but they have rebounded significantly in the recent months. Versus the opposite is happening to the growth factor. Surprisingly, the dividend factor as well as the quality factors has not done that well so far. And I guess the rotation started with a dash for trash, where the very much beaten down segments were rebounding first. And then, we expect it to be followed by higher quality, what we call the quality compounders. Also noticeable is a rebound in the small cap segment. So you see the size goes by large size. So, the large size has been negative recently, meaning that small cap has been outperforming large cap names. But volatility, companies that are very sensitive to the market, very high momentum, things that have worked in the last little while continue to work. So the message here is, with same as style and factor, is very hard to time these segments and the rotations based on that. So we need to diversify your investments in order to capture their gains and losses and capture their offsets and their diversifications between the two. So it's very hard to time these from a short-term basis. Next slide, please. Next slide is showing a difference in the style performance. So you can see obviously here, the difference between the growth style and value style. As we said before, value has shown a pretty significant rebound. Growth didn't go out of favor, but it's only slowed down quite a bit. Next slide, please. So as we go into the outlook in this year, basically two components to the total return of any investments. The first is the level of earnings growth. And the other component is the multiples that you put on the level of earnings. So what you're seeing here is one of the two elements, it's the earnings growth. What you're seeing is a big drop down, a big plummet, when we had the lockdown, when the pandemic just started. But this year, we're actually expecting one of the strongest growth in many years, because we were coming back from a lower base, and the growth percentage is obviously higher, but the earnings growth, it's expected to be over 40% in the US market. And that includes every single company. But if you exclude the unprofitable companies, which typically would skew the numbers, if you only include the profitable companies, the earnings growth is still over 26%. So that's very significant. That is a remarkable level of growth. And the cash flow and dividends are also expected to grow. So this provides a significant level of support to the overall prices. Next slide, please. But just to throw a note of caution is the lofty valuation. So valuation is quite high. This is, I think, it captures the current year. But if you look 1 year forward, the level of growth is actually pretty significant. So we're expecting a higher level of earnings, but then even with the drawback in terms of valuation, even if valuations come back a little bit, we still expect a positive level of growth. So on an absolute return perspective, we're still positive. Next slide, please. So with the economic rebound, with earnings recovery, as well as a very accommodative Fed, we still have a bullish outlook in the 2021. It's a matter of what we do, how we position the portfolio. Next slide, please. So in terms of the portfolios, we wanted to overweight equities. We wanted to improve the diversification within fixed income in the inflationary regime. We wanted to add more instruments to help dampen the volatility while we're adding to yield. But in terms of the equities, we really need to focus on the security selection. We're seeing that we want to be higher conviction. We don't want to own the entire market. We want to be focused on only on the companies that have strong growth prospects. So security selection is much more important going forward. I'll pause that right there, and I'll hand it over to Crystal.
Thank you, Judith, for that very insightful presentation. I really like the slide on where you showed sector rotation and the change in the type of stocks that will be performing in the future. I think we will see some of that move to cyclical performers also in the local market. But I'll jump right into our slide to the local slides. Next slide. And to start off briefly on COVID-19 and its impact, in 2020 alone, the government spent $18 billion to stem the fallout from COVID-19. Just on the slide there, you see the particulars of approximately 2.5 billion of that spend. On the news today, they showed vaccines, the first batch of vaccines arriving. So with that, we expect a rollout in the next couple months, and the spend for COVID-19 support should reduce in 2021. Next slide, please. Now, one of the methods used to boost the local economy has been the issuance of debt. And the Stoixian debt to GDP ratio would have increased to 80.9% in September 2020. Another facility which was used by the government was the Heritage and Stabilization Fund, with over 1 billion being withdrawn in 2020 alone. Despite these factors, right now, the credit rating for Trinidad and Tobago still remains investment grade. Next slide, please. Now, we are still operating in very much an energy economy. So there are two factors which are important. One is the prices of energy, and the other is production. In terms of prices, soy oil would have climbed over $170 over the last 1 year period, and natural gas over 46%. Also amazing increases in the downstream petrochemicals, with some products reaching 2-year highs. Now, this bodes well for the energy stream, the country's revenue stream in the short term. On the other hand, production would have suffered from maintenance works during 2020. We had maintenance at Atlantic Train 3, Train 1, and at a large methanol plant. But there is some light at the end of the tunnel for production. We're seeing some exciting news with Touchstone Exploration signing agreements with NGC for exploration, and also with Heritage Petroleum signing an agreement with EOG Resources for exploration and development. So because of these agreements coming on stream and expected increases in prices, the IMF would have lifted the growth outlook for Trinidad to 4.2% for 2021. Of course, this is also dependent on how vaccines are rolled out and how soon the country can achieve herd immunity. Next slide, please. Now, for FX reserve, they remain on a downward trend. As at the middle of March, FX reserves stood at about 8 months of import cover. For the TT exchange rate, it's been pegged for the last 5 years, and we have the government pledging its support to hold this peg. Of course, demand continues to outstrip supply for US currency. Next slide, please. Right. Now, taking a look at the yield curve would have steepened over the last year if you compare to February 2020. On the longer end, we saw yields increasing when investors were demanded a larger premium, and on the short end, yields would have declined. Now, tying into what Judith would have mentioned is happening in the United States, where positive expectations are causing these yields to shift upwards. We may see some of that later on in Trinidad as the economy improves. Now, liquidity would have been injected into the system in 2020, and we see it now falling off. With respect to policy rates, now I believe these will remain stable until we see strong signs of economic indicators that there is growth in the economy. Next slide, please. Okay, now the equity market. Over the last year, you see there's been slight increase in the composite index. In 2020, similar to markets around the world, the Trinidad Composite Index would have plummeted as investor confidence was really drained. The market hit a low in April, a year-to-date low in April 2020, where it fell over 14%. But since then, it has rebounded by over 7%. Now, there have been companies which have able to adjust and streamline their operations and their processes to work within new restrictions and to still earn profit. Next slide, please. For instance, the cross-listed index was down over 18% last year and is now up almost 4%. Some highlights on our index, NCBJ was down over 25% in 2020 and is now up. Similarly, Grace Kennedy down last year and now up. So we're seeing some positives on the market, and it's important to highlight that in every market, there are winners. So you want to look to see where the winners are in current market conditions. In this case, it seems that those companies with diversified operations, multiple revenue streams, were really able to perform. In addition, companies where they would have used these opportune times to invest and to acquire. And that will take us to our next slide. Next slide, please. Right, so a number of M&A activities in the last year. Recently, we had announcements from Grace Kennedy for the purchase of Scotia Insurance in the Eastern Caribbean, 876 Springwater, Answer Merchant Bank with the purchase of Bank of Baroda and a wind farm. So we see where all these companies are diversifying across industry or country and really just looking for ways to increase their future EPS growth. Now, next slide, please. Now, I really want to highlight the use of technology to drive productivity. So if you take a look at this slide on these icons here, they may be very familiar. I'm sure some of you have used Fruit Drop or We Eat to deliver food to your home. There are a number of companies, large and small, that have been using technology, has taken this opportunity to really push innovation and find new ways to do business. When bars were closed, there were companies delivering drinks to your home, and that's just one example. So I would say that COVID-19 has really acted as a catalyst for business innovation in the country. And it has really improved productivity, and this would carry us forward even post recovery. And to highlight also the fintech and the banking industry, I think banks have really embraced digital banking, and also customers now, in some instances, they were given no choice to use technology, but we see that this has caused somewhat of a small revolution, where people who would previously need to be in person, all those transactions are being done online, and banks are also making investments in companies to further growth in fintech. Next slide, please. Now, some of the takeaways that I want to leave here are that, stick with strong companies that have shown strength in balance sheet and the liquidity to make it to true and resilience during the pandemic. Those where we see management making key decisions for acquisitions and looking towards growth areas. Technology is key to improving productivity, and investments in technology will really drive growth forward. During the lockdown, we see this being even more and more important. And there are opportunities in every market. So right now, we would have seen the performance of the large conglomerates, those with diversified earnings. But as the economy reopens and we see growth start to present itself, I think that there will be new companies to look to, companies in the cyclical sector, where, so look for those that would have depreciated, where their earnings would have suffered, who are able to take advantage now and restructure, become more efficient. I saw some earnings come out in the last few weeks where, revenue would have remained stable, but profit increased because the company found ways to, cost strategies, ways to improve efficiency. So look to those investments. And diversification, Judith would have mentioned it, and it remains a common trend in these insights, that you need to diversify across companies, asset classes, and jurisdictions. If there are expectations for countries with high growth, look to find those investments that could give you access to those countries. And really, there's a way to win in every stage of the economy. So you just look and follow these key points here. And with that, I will throw it back to Chris.
Wow. Thank you very much, Judith and Crystal. Two very insightful and had some common threads throughout both of those presentations that I hope our investors and potential investors are going to take on board with them going forward. Definitely, Judith, I think you had some good news for Trinidad with your outlook for commodity producers to kind of lead global growth coming out of the pandemic. And we've seen, as Crystal mentioned, we've seen the bounce in commodity prices so far on a year-to-date basis. Crystal, also some very interesting observations you had on the role technology is now playing in driving productivity for the local market. I know that, I definitely do all my banking online. I don't want to go and stand up in a line, and I'm ordering more and more stuff online as well, but now from not just Amazon, but also from local companies, so I can help, with the recovery of the local economy. So again, great observations, and thanks very much for bringing those to the fore. I see a couple questions in the chat, but before we get to those, we did have a couple questions that came in online they were emailed in before the presentation. So let me see if we can address those. This first one here is for Judith. Judith, one question someone had was, while each market is unique and it's difficult to predict the future, especially during times like these, what evidence is there to support being optimistic when thinking about investing for the long term? Judith, please, you're just on mute. It wouldn't be a webcast if at least we didn't say that at least once, right?
The phrase for lockdown at home.
Okay. Can you hear me now?
So yeah, that's a great question. I think it's a very common thought that we have. But I think it's important to remember that this is a health crisis. This is not a financial crisis. I guess currently, companies are in very good shape. We see very strong balance sheets. Although some companies, like I said, different segments are affected very differently. There are lots of companies that have leapfrogged multiple years of growth in a matter of a couple of months. So we saw significant growth trends. And whereas there are some that are permanently damaged, or their prospects, the growth prospects have been damaged. But given the unprecedented level of support that the government is stimulating and it's supporting, whether it's directly or indirectly, whether it's directly to the businesses or directly to personal balance sheet, the level of support is unprecedented. Right now, we have very strong liquidity conditions, very low interest rate for credit. So I think we have very high level of confidence that not only that the economy is going to bounce back, we actually sped up in growth, in expansion. This pandemic actually, we always see opportunities in crises. There's a lot of innovations that is sparked by the pandemic. We all got very comfortable working digitally. So there's a lot of implications for changes in behavior. So, we have to continuously watch for the change of behavior, and then companies will adapt. Some companies will adapt better than others. That's why I think selection, like strong stock selection, is very important right now. But yeah, very confident that we're going to bounce back.
Thank you, Judith. I think one definite takeaway is the opportunity in crisis. It's just kind of how the perspective you have and the direction that you look at things. So that's a really good a good tidbit, a good takeaway. Crystal, we have a question for you also. With COVID restrictions continuing to depress domestic business activity, what impact do you think this will have on local markets for the remainder of the year and going forward into the future?
Okay. Now, I will say that we have seen the negative impact that restrictions so far have had on business operations and revenue. However, we have seen that some companies were able to perform, in particular those selling staples such as groceries and pharmaceuticals, and there were also those who were able to innovate, whether that be through acquisition or just streamlining of their processes. So there will be performers, and there will continue to be performers later in the market as some of these restrictions are eased. I'll highlight again that we will see a move towards companies in the cyclical sector performing, that is financials, discretionary, and energy companies. And that is where you want to look. I do think that growth is ahead, and we will see positive performance. So to piggyback on Judith, it's a healthcare crisis we're seeing there, and the economy gains legs and businesses are reopened. I think that there is growth, there's selective growth, and again with the stock selection, company selection, be sure to pick those that would benefit from this transition that is happening right now.
Right. Thanks, Crystal. And we just got Judith back. Let's give her 1 minute to reconnect. Hi, Judith.
Sorry about that.
Ooh, you got me worried for a second there. I guess you're stepping right back into the hot seat. So we have one more question here for you. You did speak to it during your presentation, but maybe I guess you can just say again. So as we said, as you said, U.S. interest rates have shot up significantly over the past few months, with investors seemingly pricing in a return of inflation, and this has rattled both equity and bond markets. Do you see this as a cause for concern for investors, or are fears of an end to the bull market being overstated?
Yeah, so it's a very hot topic, but I think I said in my presentation as well, we expect to see volatility in the level of inflation. So sometimes we will see spikes in inflation because of the disruption, the supply chain disruption. But over time, I think companies will adapt to it and will adjust that value chain to deal with it. So we may see, inflation coming back down for a couple of periods. But, if the inflation is in a moderate level, and, typically, historically, in a moderate level of inflation, the market can actually digest that. So we do expect bond yields to be higher, and we expect bond yields to stay a little bit higher. But that won't be permanent, and, depends on your portfolio. We really have to diversify within the equities portion, like I said, to have a diversified mix between the shorter duration equities as well as the longer duration equities to mitigate that impact from inflation. Within fixed income, we really want to diversify to build in flexibility to mitigate the impact of the steepening of the yield curve. If the yield curve is steepening, you don't want to have long duration assets. You want to stay in those short duration assets, but that may change over time as inflation changes. So with that volatility, you really need to include the flexibility, built-in flexibility to tactically mitigate as well as capture the opportunity because caused by the volatility in inflation. We also, in the way that we are building portfolios, we also stress test the portfolios to see how the portfolio will react to a significant change in inflation, and make sure that we don't have outside concentration or biases in somewhere where we're not managing that risk. So risk management is significantly important at this point.
Great. And risk management through diversification, right? Which again is the current, just one theme that has run through this presentation. Just I guess to clarify for some of our attendees, Judith, when you speak to long duration, I'm sure they're familiar with duration on the fixed income side in terms of the life of the assets and whatnot. When you say long duration equities, can you just break that down a little bit for our attendees?
Yeah, long duration equities is what I addressed as well. So those are the companies where the valuation of those companies is based on a longer term cash flow and profitability, such as in IT. A lot of the IT and software companies are based off of a long-term projection of their cash flow growth, of their cash flow and profitability growth. And the valuation of that is to discount the future profitability back into the present value using the interest rate. So the changes in interest rate is actually very impactful in terms of to their valuation. So those need to be diversified with shorter duration industries, such as the bricks and mortars industries, financials, industrials, financials, the manufacturing companies, so companies that pays a dividend, that is currently already paying a dividend and currently already profitable. So if you offset with companies like that, you get a diversification of this.
Great. Thanks very much for clarifying, breaking it right down. Crystal, we have one more for you as well. It's a hard question. I'm glad you're not asking me. With the global shift away from fossil fuels taking hold, what impact do you expect this will have on commodity producing economies such as Trinidad and Tobago?
Well, that is a very interesting question and relevant. Now, this shift is not something new. We've seen it happening already within Trinidad, where more and more persons are driving hybrid vehicles, and the use of solar products have been increasing. Now, that being said, the demand for energy is expected to increase in upcoming years. Now, the shift from the use of fossil fuels to the use of renewables, I think, will really take hold, according to experts, within a 20 to 30-year period. So with that, I think the government has time to use technology to innovate and find ways to reduce the harmful impact of fossil fuels on the environment. You know, natural gas, I believe, is considered to be less harmful for the environment. Now, it brings back into play the story that we hear year after year in Trinidad of diversification of revenue streams. And this has to happen also. But there are ways to refresh and renew how the energy sector is before the eventual transfer of this market share. I hope that helps.
No, definitely.
Question.
And I have one more question. It was addressed to Crystal, but I'd like Judith to get her insight as well too. It's a bit more of a generalized question. So what advice would you give to someone who's interested in starting to build their own personal investment portfolio?
Yeah.
Judith, you want to start up?
It's interesting because as we've had outsized gains from fixed income as well as equities in the last, say, 12 to 15 months, we need to dampen our expectations for the returns in the next couple of years. So our forward-looking returns expectations for across asset classes have generally come down, and the future experience will be lower on returns relative to historical experience. So what we really need to do is to revisit a couple of things. So we need to revisit our risk tolerance. Can we take a little bit more risk, to lean a little bit on equities, not to give up on fixed income. Fixed income is still a capital preservation asset class. We need that to offset the risk. But how it really be real about how much risk we can take. What are the extreme downside that we can handle? Another level is, can we save a little bit more money? Expecting our returns on investments to be a little bit lower. But like you said, throughout the whole presentation, diversification is really important. We need to look across the board and find value within each of the asset classes. At this point, it's relative value. It's not just a valuation. It's valuation relative to each other and to other equities that is important. And we need to build in flexibility to react to changes in the market because of that dispersion of return. It's a lot higher between equities, between sectors, between segments of the economy. Again, revisit our risk tolerance. Can we save a little bit more? Can we spend a little less? All are important questions when building a personal portfolio and positioning the portfolios that we manage.
I think that's timeless advice, Judith. Save a little bit more, spend a little bit less. Crystal, same question to you. Any advice for someone looking to start their investing journey, today or tomorrow?
I'll just reiterate some of what Judith said. Start off with knowing your goals. Learn your goals and know your risk appetite. How much losses are you willing to take for the possibility of return? And then select your asset classes based on your appetite and your goals. It really should be specific to you, and look for value within these asset classes. Seek out relative value, and speak to a personal advisor on the best ways to access these investments, as there are multiple ways in a local market to gain access to, whether it be stocks or bonds, real estate, whichever asset class is most suitable to you.
And again, more timeless advice. Thank you very much, Crystal. I think that's definitely a good takeaway. On that note, I mean, we could go on and on and on, but we have to, let Judith and Crystal get back to their day jobs. We're getting up to the top of the hour, so we just need to wrap things up. So I just want to thank everyone for joining us here today, especially our two esteemed panelists, Judith Chan out of Toronto and Crystal Salazar here at SITT. Thanks for your time, your participation, and to everyone in attendance as well, thanks for your questions. That's it for us today. Within the coming days, we'll email you the link to the video from this meeting. And of course, feel free to share any other questions you may have for our panelists by email, and we'll get back to you with their answers. So on that note, take care, everyone, and remember to stay safe. So thanks again for joining. Have a good afternoon.